what is the VIX and why is it so important to the options market? That's because the VIX is the volatility index, and many people are calling it the fear gauge. Why is that? First of all, volatility is a likelihood that a stock is going to move up, down, or sideways, okay? So any which way. If there's a higher likelihood that a stock might make a massive move in any which way, then that stock is a lot more volatile. It has more volatility, okay? Now, the broader market in general has its own volatility measure, and that's where the VIX comes in. The VIX is measuring the market's volatility, and that's why they call it the fear gauge. So I'll give you an example. If we see a high VIX, higher than normal for the past 12 months, that would be something like 28 to 30. If there's a 28 to 30 VIX in the market, then fear should be higher because volatility is higher. So yes, there could be a lot of upside when you have a high VIX. There could also be a lot of downside when you have a high VIX, okay? The stocks can move either which way with volatility. When we have a really low VIX comparatively to the past 12 months, let's call it a 10 VIX, then the fear gauge is low. In general, fear has been sucked out of the markets because there's a lot less volatility. When stocks are moving more like this, side to side, and less like this, then the fear isn't as present as it is when we see a face-ripping VIX like 28 plus. Now, the VIX resets itself monthly to measure the broader market. However, we do track it every single week to make sure when we trade in these options that we're not getting into only positions when the market has a very high VIX, and we're also not getting into all our positions when the market has a very low VIX. You want to be diversified.